Don't miss out on this once-in-a-decade opportunity to generate a life-changing amount of money. Make sure that you pay close attention to this video. The reasoning is based on the belief that economic downturns, like a recession, can lead to financial success, but only if you invest at certain times and play the investing game the right way. You see, financial institutions and the wealthy people, like the great Warren Buffett, prefer to invest during periods of recessions and declines in the markets. We'll go into greater details behind the reasoning behind this matter later in this video. Recessions are a normal part of economic cycles, and with proper use, they can give you incredible opportunities to ensure your financial well-being for the rest of your life. In an article by Forbes, they state the following: according to Buffett, a recession is one of the best times to look for investment opportunities. In 2008, he wrote, "Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price." Warren Buffett's saying means that during tough economic times like a recession, and bad news creates opportunities for investors. Stock prices might decline in response to bad news, allowing investors to buy strong company shares at a deal. Buffett sees this as an opportunity to take advantage of the lower prices and invest in the future growth of America. Therefore, he thinks that negative news might be an investor's best friend by providing an opportunity to buy valuable assets for less money, with the hope of earning long-term rewards. He advises investors to embrace challenging market conditions and use them to their advantage. He supports a different way of thinking during recessions, which is to not to be afraid. Buffett sees an opening to be a smart buyer when others are panicking or selling assets. By remaining calm and focused during periods of volatility, investors can capitalize on the market's rapid movements. Buffett's approach involves looking at past current problems and understanding that economic downturns often create opportunities for successful long-term investing. Investors are encouraged by Warren Buffett's philosophy to see the market's downturns as opportunities for growth. He views these times as an opportunity to make smart asset purchases, setting investors up for future prosperity when the market is up, while others may be inspired by fear or uncertainty. Later in this video, I will reveal 3 important things every stock investor must do before and during a recession to help you maximize your profits. There have been a couple recessions in the past decade. In fact, let's take a deep dive into one of them called Great Recession, also known as the 2008 housing market crash. So what caused the 2008 financial crisis, you may be asking? And to answer that question, let's look at an article from Investopedia.com. In this article, we could read the following: the 2008 financial crisis began with cheap credit tax lending standards that fueled a housing bubble. When the bubble burst, the banks were left holding trillions of dollars of worthless investments in subprime mortgages. The Great Recession that followed cost many their jobs, their savings, and their homes. In the lead up to the 2008 financial crisis, banks made it easy for people to get loans due to cheap credit and relaxed lending rules. This led to a housing bubble that saw prices for homes rise. When this bubble burst, home values collapsed, leaving banks with massive losses on subprime mortgages, high-risk loans given to people with poor credit. The Great Recession began as a result of the financial crisis spreading globally. The crisis affected people's lives as savings disappeared, jobs were lost, and many faced bankruptcy. In a detailed chart provided by the Motley Fool, we could see that the 2008 recession actually began in December of 2007, and we could see that the S&P 500 and the Nasdaq slowly falling down. In March 2009, the markets reached the bottom, and soon after, the market started to recover. Fast forward to 2011, the US economy officially recovered and reached an all-time high. The stock market often undergoes downturns during economic downturns, offering wise investors unique opportunities. These downturns in the economy might be viewed as special opportunities to generate wealth throughout well-timed investments at discounted rates, similar to a shop where you may purchase goods at a discounted price. An economic downturn allows investors to purchase assets at a lower cost. When the market eventually recovers, investing at lower entry points could bring in large profits. Recessions are often seen by intelligent investors as a blessing and a curse for long-term wealth growth. People can put themselves in an opportunity for long-term financial stability by carefully choosing low assets during recessions. According to Wikipedia, there have been 15 known recessions in the last 100 years. So that means on average, recessions occurred approximately every 6 to 7 years. Remember that a number of factors such as changes in the economy cycles, international events, and government actions can affect the state of the economy and the frequency of recessions. Let's now touch on America's past 5 recessions. The 1980 recession began with the Federal Reserve, led by Paul Volcker, rising interest rates to combat the rapid inflation of the 1970s. This move triggered a distinctive double dip, or a W-shaped recession, characterized by a brief economic downturn, followed by a short period of growth, and then a deeper recession. The result was a challenging economic period in the early 1980s, marked by elevated unemployment levels. The 1981 through 1982 recession, influenced by the Iranian Revolution and sudden surge in the global oil prices, saw the implementation of a tight US monetary policies aimed at controlling inflation. The recession continued the double dip theme, presenting a complex economic landscape in the early 1980s. Moving into the early 1990s, the US experienced a brief recession following the pacetime expansion of the 1980s. Rising inflation prompted the US Federal Reserve to raise interest rates. However, a combination of factors, including the 1990 oil price shock and consumer pessimism, contributed to the economy downturn during this period. Early 2000s recession occurred from March 2001 to November 2001, followed the longest economic growth period in US history. During the 1990s, the burst of the dot-com bubble and the aftermath of the 9/11 attacks led to a brief and shallow recession. Despite these significant shocks, the US economy demonstrated resilience, rebounding relatively quickly. The Great Recession, spanning from December 2007 to June 2009, was triggered by the subprime mortgage crisis, causing the collapse of the US housing bubble and a global financial crisis. Massive failures in financial institutions prompted an unpredicted government response, including a $700 billion bank bailout and a $787 billion fiscal stimulus package. And lastly, the recent pandemic, which started in February 2020 through April 2020, resulted from the severe economic impacts of the pandemic. Despite being one of the shortest on record, just lasting 2 months, it left a significant mark with a 14.7% unemployment rate and a staggering negative 19.2 GDP drop in April 2020. The length of recessions can vary, and there is no fixed duration. Recessions usually last anywhere from a few months to a few years. Recessions in the US have usually lasted 11 months on average since the end of World War II. But it's important to remember that a recession can be caused by several things, including outside factors like events around the world. Economic policies and other events can also affect how long a recession lasts. Each recession is unique, and the length can vary based on specific factors that contribute to the event. I would also like to shed some light on another important investing quote from the great Warren Buffett. And the quote is, "The stock market is designed to transfer money from the active to the patient." This quote by Warren Buffett means that the stock market often moves money from people who trade frequently to those who stay invested for a long time. In simple terms, it suggests that being patient and holding money onto investments could be more profitable than constantly buying and selling in the short term. People who do frequent stock trading might base their decisions on unpredictable short-term shifts in the market. Being patient means hanging onto stocks for a long-term period and letting them appreciate over time. According to Warren Buffett's advice, the concept behind this is that in the long run, patient investors typically see larger returns than those who aim to turn a profit quickly by constantly buying and selling stocks. It provides a reminder that self-controlled and a long-term outlook are often required for successful investing. As a reward for staying through my video, I will now reveal the 3 things that every stock investor needs to know both ahead of time and throughout a recession. First thing is holding cash. Holding cash offers you liquidity. Having cash on hand provides liquidity, allowing you to take advantage of investment opportunities that may come up during a recession when assets prices may be lower. It also provides you with an emergency fund. Without having to sell investments at a loss, reserves of money serves as a safety net to help you pay for unexpected bills and living expenses. Number 2 is to diversify your stock portfolio. This helps with risk reduction. By spreading your investments across a variety of assets, sectors, and areas around the world, you can reduce risk. In a recession, this reduces the effect of a single investment performing poorly. It also offers investors stability. In any kind of market condition, having a diverse portfolio containing stocks, bonds, and possibly alternative investments could help maintain stability. And lastly, the last thing you should definitely do is to invest for the long term. By doing this, you get to ride out volatility. Investing for the long term gives you the ability to withstand short-term market shifts, even those that are caused by recessions. It reduces the need for panic sells during economic downturns. When investing for the long term, you get to capitalize on the recovery, meaning recessions are typically followed by periods of economic recoveries. And investing with a long-term outlook allows you to profit from a future rise in asset prices. Before a recession, you have to be wise where you invest your hard-earned money. In fact, you guys should check out this video where Robert Kiyosaki reveals the one thing he is buying right now before a crash. Go find out what asset he was talking about, and don't forget to like and subscribe for more.